Hey there! Are you tired of feeling like the taxman is knocking down your door every year? Do not worry, Immaticus Learning is here. In today's video, we are diving into some game-changing tax planning strategies for Indian businesses that can save you big on your tax bill. If you are running a business in India, this one's for you. Let's get started with the basics and some smart tips to keep your hard-earned money in your pocket. Okay, first things first. Why should you care about tax planning? Well, effective tax planning is like a financial GPS guiding you towards maximum savings. It helps you minimize your tax liabilities, improve cash flow, and ensure you are not paying unnecessary penalties for not following the tax laws. It's like finding a shortcut through a traffic jam, but for your finances. Let's start with something super important: choosing the right business structure. It's like picking the right tool for the job. Here's why it matters. Sole proprietorship. Simple to set up, but your personal income gets taxed, which means the bigger your profits, the higher the taxes. LLP, limited liability partnership. You get to enjoy limited liability protection and no double taxation like in a regular partnership. Private limited company. This one's a winner if you want limited liability protection and lower corporate tax rates. Just 25% for businesses with turnover under rupees 400 crores. Pretty sweet, huh? Example. Let's say you are a small tech startup. Forming a private limited company could save you big time on taxes compared to being a sole proprietor. Alright, let's talk deductions and exemptions, aka your secret weapon. First up, capital expenditure. For businesses in sectors like cold storage or warehousing, you could be eligible for a 100% deduction under Section 35AD. Yes, you heard that right. 100%. So, if you are setting up a cold chain facility, this is your ticket to huge savings. Example, imagine you run a logistics company setting up a cold storage for perishables. The capital investment, fully deductible. That's huge for your bottom line. Now, for the businesses registered under GST, here's a trick that could save you a lot of money. Input tax credit, ITC. You can claim ITC on taxes you paid on goods and services you use for your business. For example, if you bought raw materials, you can offset the tax paid on that against the tax you collect from customers. Simple, right? Example, let's say you run a manufacturing unit and bought raw materials for rupees 1 lakh plus GST. If you are registered under GST, you can claim that GST back. That's money you don't have to pay to the taxman. If you are a small business owner with a turnover of up to rupees 2 crores, here's a game changer. Presumptive taxations. Sections 44AD and 44ADA let you declare a fixed percentage of your gross receipts as income without needing to maintain detailed books of accounts. That means less paperwork and more savings. For example, under Section 44AD, small businesses can declare 8% of their turnover as income. No questions asked. Example, for a small retail shop making rupees 1 crore in annual sales, you would only need to declare rupees 8 lakh as taxable income. Boom! Less hassle, more savings. Another pro move, taking advantage of tax incentives. If you are in a special economic zone, SEZ, you could get exemptions from corporate taxes and custom duties for up to 5 years. Example, let's say you set up a manufacturing unit in SEZ. For the next 5 years, you might be totally exempt from corporate tax. That's a huge incentive to consider for expanding your business. And here's something everyone can benefit from: embracing digital transactions. Not only does it reduce your risk of audits, but it also makes your records crystal clear for tax filing. Using accounting software to track your income and expenses can also streamline the whole process. Trust me, digital is the way to go. Let's talk capital gains. When you sell a business asset, you'll pay tax on the profit. But did you know that long-term capital gains are taxed at a lower rate than short-term ones? Plus, with indexation, you can adjust the purchase price of your asset for inflation, reducing your taxable gains. Example, say you bought property for rupees 50 lakh 5 years ago and now it's worth rupees 80 lakh. By applying indexation, the taxable capital gain is much lower thanks to inflation adjustments. Bonus tip: making further selective investments can also help you adjust your capital gains. For instance, under Section 54 of the Income Tax Act 1961, you can claim exemptions by reinvesting your gains in specified assets like residential property, thus reducing your tax liability. There you have it. Tax planning doesn't have to be boring or confusing. By making the right choices, whether it's picking the best business structure, claiming deductions, or leveraging tax incentives, you can save a lot on your taxes. Remember, tax planning is not a one-time thing. So stay updated with changes in tax laws and always consult a pro to make sure you're on the right track. Now, go ahead and put these strategies into action and let your business soar. If you enjoyed this video, hit that like button, share it with your fellow business owners, and don't forget to subscribe for more smart business tips. Got questions about tax planning? Drop them in the comments below and I'll get back to you. Until next time, keep saving, keep growing.